Somewhere, right now, a payment is happening. No cash, no gold, no physical exchange of anything real. Just numbers moving across a screen. And here's the uncomfortable truth. Most of the money in your life does not exist. Not in your wallet, not in a vault, not anywhere you can touch. Money, as we once knew it, quietly stopped being real, and almost no one noticed. For most of human history, money had weighed metal coins, silver, gold, something scarce, something physical. If you held it, you owned it. Then paper replaced metal. Governments promised the paper represented gold stored somewhere safe. You could, at least in theory, exchange it for something real. But in 1971, the system quietly changed. The United States, the anchor of the global financial system, severed the dollar-s link to gold. No dramatic announcement to the public. No global bounty, just a policy decision. From that moment, money was no longer tied to a physical asset. It became an idea, a belief, a shared agreement that numbers and accounts represent value. And once money became belief, the roles changed. Today, over 90% of the world's money exists only as digital entries in banking systems. Not printed, not stored, created electronically. So how is this digital money created? Not by governments printing endlessly. As money asumi, most money is created when banks issue loans. When you take a loan to buy a house, the bank does not hand you existing money from a vault. It creates new money out of thin air by typing numbers into your account. Your debt becomes new money in the economy. Loans create deposits. Debt creates money. And this is where the system becomes strange. Because if most money is created through debt, then the system requires continuous borrowing to keep functioning. If borrowing slows down, money creation slows down. If money creation slows down, economies stall. Growth in this system is not optional. It is structural. Now consider interest. When money is created as debt, it must be paid back with interest, but the interest portion was never created when the loan was issued, which means, collectively, the system always requires more borrowing to service previous borrowing. Not necessarily a conspiracy, not necessarily a flaw, but a mathematical pressure built into the structure. And this pressure shapes everything: housing prices, inflation, market cycles, even government policy. Central banks sit at the center of this system. They do not print money the way most imagine. Instead, they influence how easily money can be created by adjusting interest rates and liquidity. Lower rates make borrowing cheap. Money expands. Asset prices rise. Economies feel strong. Higher rates make borrowing expensive. Money creation slows. Asset prices fall. Weakness appears. Notice something subtle. Central banks do not control money directly. They control the cost of debt, the fuel of money creation. And sometimes, they create money digitally themselves. In recent years, trillions of dollars, euros, and yen were created through a process called quantitative easing. No trucks of cash, no printing presses running wild, just digital balance sheets expanding. Markets rose. Asset owners gained wealth, and the system kept moving. Now here's where public perception and reality diverge. Most people believe money represents stored value, something solid, something earned, something saved. But in reality, modern money is closer to a flow than a thing. It must move. It must circulate. It must grow. If everyone tried to convert their digital balances into physical cash at once, the system would freeze. There isn't enough physical currency, because most money was never physical to begin with. And yet, despite this abstract structure, the system works, because trust holds it together. Trust that banks will honor deposits. Trust that governments will stabilize crises. Trust that numbers on screens will still buy food tomorrow. But trust can be fragile. History shows moments 2008, for example, when confidence cracked and the system nearly seized, not because money vanished physically, but because belief wavered. When belief weakens, liquidity disappears. When liquidity disappears, markets panic. When markets panic, Institutions intervene to restore confidence, often by creating even more digital money, which brings us to a strange paradox. The more unstable the system becomes, the more money must be created to stabilize it, and the more money that is created, the more abstract, more detached from physical reality the system becomes. So, if money is no longer physical, no longer scarce in the traditional sense, and largely created through debt, what is money, really? A tool? A contract? A belief system? Or a mechanism of coordination that only works as long as everyone agrees it works? For now, the system continues. Payments clear. Markets open. Numbers move. Life goes on. But beneath the surface, modern money is not a solid foundation. It is a carefully balanced structure of trust, debt, and digital creation. And structures built on belief do not collapse when something breaks physically. They collapse when people stop believing. So here's the unresolved question. If money is no longer something real, only something we agree is real, what exactly are we all trusting?